Hello, everyone. Welcome to this December edition of The Pitch. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. It's a pleasure to bring you this special event about once a month. What we like to do is bring three very capable expert strategists, traders, and have them share five ideas, right? Five pitches, stocks, ETFs, themes that they're looking at, have them frame out the charts that are informing those decisions, and then have a good discussion as a group about what we've learned from that, from those ideas and how we should be looking forward as investors. We have three fantastic guests, all that have been on the pitch before. So we're bringing in some of the top experts on a day which is not maybe the easiest day to do this sort of thing. So thank you guys for bravely coming on. We have Katie Stockton, who's the founder of Fairlead Strategies. We have Dave Landry, founder of DaveLandry.com, coming to us from Louisiana, and Larry Tentarelli, editor of the Blue Chip Daily Trend Report. Folks, thank you guys so much for coming on, and thank you for bravely coming on a day when the market just does not seem to find a floor. But we're excited to sort of go through these things together, guys. So the format, if you've not if you've not seen the pitch before, is we'll basically go through each one of the 15 pitches. Each one of these brave experts, Katie, Dave, and Larry, have given us five ideas ahead of time. We'll go through each one of them individually, and then we'll discuss them all as a group in the second half of the show. Katie, are you ready to get us started?
Yeah, ready to go, Dave.
All right. So this first one is an ETF. I don't know, Katie, if you're familiar with this one. It's called the Fairlead Tactical Sector ETF. Can you talk us through this one?
Yes, of course, Dave. So this is the ETF that I manage, and the ticker is TACK, or we call it TACK. And it is tactical. It's also technically driven. And the idea behind it is that we really want to leverage sector rotation. So it's a fund of funds that primarily is looking for the best sectors of the market in terms of long-term momentum, long-term relative strength, and looking at long-term overbought, oversold indications. Of course, in this bear market cycle, the sectors are largely not going up. They don't have long-term upside momentum. So we have in the TACK ETF the ability to move to risk-off exposure, or what we consider to be that. And that comes via short-term Treasury positions, long-term Treasury positions, and gold positions via GLD. And those are places to essentially hide in a bear market cycle and to limit your drawdowns, to reduce the volatility. And as it stands, we do have that exposure in addition to the energy sector being really the last man standing from a technical perspective.
Interesting. When you're looking at the performance of TACK, it's really started to improve. What would you attribute sort of that most recent rally to? I would assume it's some of the more defensive positioning in place at the moment.
That's right. So we've had a backup in Treasury bonds, of course, as yields have come off their highs. And at the same time, we've had a nice relief rally in the price of gold. So this has been an unusual year from a macro perspective, as we all know, just in terms of most asset classes really being in sort of a bear market cycle of their own. And yet we've seen this counter trend move that's benefited TACK and of course, the broader equity market as well, to which we hold ourselves against in terms of our benchmark, the S&P 500. We also have a Morningstar benchmark that we compare ourselves against. And proudly, we are beating the S&P 500 by a strong measure, even stronger today with the action that you cited to the downside. We just want to find a place to park our money where we can manage risk and sort of limit those drawdowns. So TACK is in the red this year by about 3.8% as of today. And obviously that compares favorable to the S&P 500, which is about 11.6% as of the inception of TACK. So that's what we're trying to do. And in terms of the chart itself, obviously the rally is supported by upside momentum. We would expect TACK to consolidate when the market is trending lower, or when the equity market is trending lower. And yet we'd expect that relative performance to really shine, though.
Appears to be setting up pretty well there, Katie. I would have been disappointed had you not started strong with TACK, but listen, congrats on the launch and good luck, of course, with to your ongoing success.
Thanks so much,
Dave Landry. Thank you so much for joining. How are you?
Doing great, Dave. Glad to be back.
And again, we tried to bring in our top guests on knowing there was a lot of uncertainty, a lot of choppiness in December. So thank you for being one of those three that we would lean on. Your first chart is talking, I think, a little more big picture about the S&P. What is the idea here?
Well, back in August of last year, I was warning that, hey, sooner or later we're going to have a bear market, and people call me after the bomb blows up, so to speak, and ask me what to do when the market's down 30 or 40 or 50%. It's like, well, the bomb's already blown up. It's too late. So way back in August last year, we're making new highs. I showed this system to the StockCharts people and say, hey, look, guys, pay attention to this. When we get a sell signal here, we need to get out of the way. And as I was talking with you earlier, the green line is 10% off of the all-time highs. And my theory is with technical analysis, if a market's going to go down 50%, it's going to drop 10% first. Now, you can't just exit a market at 10%, but something like the S&P 500, that's a pretty good area to exit. So if it's below the 50 simple and below the 10% line, you get out. Now, I would never time a market based on timing alone, but obviously the longer we're in a bear market, the closer we're coming to the end. So I wouldn't rush out and buy the S&P just yet, but I wanted to show this now while we're not doing so hot just yet, although we are improving in general. But it would take for a buy signal, it would take two lows above the 50 simple moving average. That's a weekly moving average. These are weekly charts, a weekly chart, and a close above the buy line. Now, what I was talking about with the time, the buy line or the 10% line is based on a 50-week closing high. So notice it didn't do anything all year because it was based on the high way back last December. Now that we're 50 weeks in, it's beginning to catch up with price. So this is a great little system for a market that makes a longer term bottom as opposed to a V-shaped recovery like we saw back in the pandemic. It got you out, but then it got you back in a little bit late. And there's other things to get you in shorter term. But I just want to show this now that the market's continuing to be questionable in here. And again, two lows above the 50 simple moving average and a close above the buy line, which means you're within 10% of all-time highs. And that's it. I'm kind of amazed at how the system works. It's actually called the trend following moron 10% system.
I was going to say, technically, the TFM 10% market timing model. Well done, and thanks for talking through that. I love that, and I love that recognition. If and when we see a reversal to the upside. Larry Tentarelli, thank you for being our third panelist today. How are things your way? Okay,
Dave, great. Thank you for having me back on. I appreciate it.
No, you're one of the best. You always bring some good ideas, and I've mentioned this many times before, Larry, when you've been on this show or on my show, The Final Bar, is I'm always envious with the charts that you share because you seem to have the ability of keying in on the actionable charts. So I'm excited to see what names you're sharing in a challenging time, to be honest with you. AbbVie is the first name in the biotech space. Can you talk us through this one?
Sure. So I brought a couple positions that I'm long and a couple that I've got on watch. So we have a long position in AbbVie. If we just look at the chart, it's trading over 4 rising moving averages. That's the first thing that I like to see. It's just below potential breakout to all-time highs. But I've got healthcare ranked as our number one sector for quite a while now. And what I see with AbbVie is a consolidation over the 20-day moving average, recent 50, 200-day cross. Now, obviously, what happens in the overall S&P 500 can have a lot of bearing on these individual charts, but AbbVie's a very strong uptrend in a very strong sector.
Leading stocks and leading sectors. That seems like a decent way of approaching this whole game we're struggling with, I feel like. That's a great idea. And thanks so much, Larry, for chart number 1. Katie, we're back for chart number 2. You mentioned gold as part of where you've been focused. GLD is the second chart. What is this telling you?
Again, we're out on the search for the relative performance, and GLD as representative of gold, the commodity, and importantly, not gold, the stock. So we're looking for this kind of pure commodity exposure, and also, a chart that just looks better than average. When we're looking through our sort of bottom-up work in the equity market, it's hard to find long-term setups that are compelling, but we are compelled by the chart of GLD, noting that there's a long-term oversold upturn. And with that, we've seen intermediate term momentum improve with what it was a bullish reversal of the downtrend that was in place for several months. So we believe that this reversal is something that has longer term potential. The longer term oversold reading that we are seeing GLD react to is something that wasn't shared by a lot of equities. So we're excited to see this reversal. We would not rule out a near term sort of consolidation phase or pullback, but that to us would be something that would be viable because I think once we see gold as a commodity get through about 1800 more decisively, the next targeted level is about 100 points above.
Very, very good. And I should have mentioned, Katie, this is a weekly chart of the GLD. So here we're testing the 40-week, similar to the 200-day moving average. Great chart. And I love that description. It's so funny as Dave, as I bring up your second chart with gold, if you told us ahead of time, right before the year started, that inflation was going to be the biggest issue of the year and that the equity markets would have been down, gold seems like a layup in that environment. It's not been the case, but really starting to improve, Katie. And thanks for highlighting that with your second pick. Dave, we are ready for your second pick, which is a name some may not be familiar with, SONX. Can you talk us through this healthcare name?
Yeah, as we discussed early on, the pickings were sort of slim now. And lately I've been telling my clients, don't do anything. And they're paying me to tell them to do nothing, which probably makes no sense in their heads. But every day I come out, they're probably sick of me saying it. It's like, man, I wish somebody would have told me 20 years ago or 30 years ago, you don't have to always be trading like crazy. Sometimes you better be out of the market. So this is a little bit more representative of a possible type of setup I look for, but I don't see this as a perfect chart and something that I wouldn't take. So kind of more of an evergreen kind of content here. But what I like about it is we have it bottomed out, and you can see it was at a longer term downtrend. And you'll notice vis-a-vis the 30 EMA, we had all the downside Landry light, which is just highs less than the moving average. And I like to use the illustrator, as I like to call them, versus indicators. And it just kind of illustrates what's already in the chart. But notice we did flip over back to red, and the system, or the setup, I should say, looks for about 20 bars or so of upside Landry light, then a pull back to the EMA. Now, in order for it to trigger, you would have to wait for this stock to rally. So a trigger on this would probably be, with today's sell-off, around 225 or so, and maybe stop out a little bit below today's low should you go after it. Now, again, it's not a beautiful setup, but it does kind of illustrate the point I'm trying to make about a Landry light pullback. And when we eventually do make the turn, start looking for these, and then maybe even shorter term periods, maybe 10 periods or so, and looking for those pullbacks to the moving average. So I think it's a great little simple pattern, easy to recognize, to use when the market does begin to turn.
Yeah, it's with a number of the indicators that you have on our ACP platform, Dave. They're simplistic in a lot of ways, but beautifully powerful in terms of the visual cues when something's changing. Thanks for highlighting that one.
Thank you.
Larry, we are on to your second chart, our first repeat of the day, which I'm not afraid, because that means we're reinforcing an idea. You have GLD on your list as well. Can you share with us why that's the case?
Sure. So GLD, we can really talk about two things. The chart, we'll start there. So first with GLD, it's in a shorter term uptrend. It looks like it put in a low in November. It had the first close over the 100-day moving average going back to April. And it did that on some heavy volume, if you look on the bottom of the chart. So that was a constructive sign. We've got recently higher highs, higher lows. The 50 days started to turn up. Recent test of the 200-day moving average. And I've got the same view that Katie does, that there could be a pullback. So the US dollar has obviously rolled over, and the dollar put in a top in September. And then if we take a look at the GLD chart, it had a low in September. Then it undercut that just by a little bit in November before the reversal. The dollar's bouncing a little bit today. It might be oversold. There could be some pullback in GLD, but I've got a position here, and I do plan to add to it on any pullbacks.
Ooh, great chart. And thanks for talking about the dollar. As I was mentioning earlier about how gold has been such a difficult area of the markets in 2022, the strong dollar has just absolutely tortured this. But the weaker dollar in the last 6 to 8 weeks, has really given room for charts like the GLD to make some progress to the upside. Thanks so much for that one, Larry. That's a great one. Katie, we're on to your third one. This is our first short idea of the show. We're talking short semiconductors. Talk us through the idea here.
Yeah, so we tend to see semiconductors outperform on the upside and underperform on the downside. So we've seen some real outperformance of late by SMH versus the S&P 500 with the recent relief rally since about mid-October. And yet that uptrend, or that short-term up move, is looking pretty extended both in absolute and relative terms. You can measure that in part based on the weekly stochastics. You can see an overbought reading there. And there's also signs of short-term upside exhaustion per the DeMark indicators. And that would suggest that we'll see some kind of retracement here for semiconductors measured by SMH. And we would look for SMH to essentially exhibit downside leadership if indeed we do see the S&P 500 also extend lower here, which we think will be the case. So looking for sort of the best groups to be short or to express a downside view, semiconductors would be one of them.
Interesting. And you see that again, this weekly bar has not played out yet, but sort of a sign of negativity if we're trading above the 200-day and just managing to close right back below it. We'll have to see how the week plays out here, but obviously a lot of pain so far today. Thanks for sharing that one. A good idea to the downside there, Katie. Dave, we have your third chart, which is an aluminum name, CENX. Can you talk us through this one?
Yeah, I'm actually long this one. If you go back a little bit in time, you'll see that this was a bow tie setup where the moving averages, 10 simple, 20 exponential, 30 exponential, flipped over from downtrend proper order, red on the bottom, to uptrend proper order fairly quickly. It took a few days to happen. And then once that happens, you look to trade the first pullback, which was kind of interesting. A lot of technicals come together at the same time. It's also kind of a bigger picture cup and handle. If you go off to the pullback right there, yeah, to the right side, there you go. There's your cup and handle. And I am long, but I'm very close to being stopped out of this one. But it does still look like a bigger picture bottom, so maybe the next signal might be worth taking. I wouldn't rush out and buy it just yet. Again, I want to kind of show the thinking behind my analysis. I don't trade off of big picture technical analysis like a cup and handle, but I do like when it backs what I'm seeing. And sometimes you get the bow tie set up within a bigger picture cup and handle. And that's what I'm seeing here. So far, though, unfortunately, it just hasn't materialized. And it kind of illustrates the point. It's kind of like better to be on the dock drinking beer, wishing you were out to sea, than out to sea, wishing you were on a dock drinking beer, which I've almost sunk offshore a few times, so I know all about that. But unfortunately, it didn't work. It's or at least not yet. But it was a setup that was worth taking, and sometimes you have to take your lumps, and I think that's the kind of market we're in. I think we were chatting earlier about, hey, it's tough markets, and we have tough times just like everybody else, and a lot of times we just have to sit on our hands and, like Katie said, go into cash or something cash equivalent or something that's strong on a relative strength basis. So
yeah, Greg Morris, who's one of my mentors as a student pilot and also as an investor, his version of that was it's always better to be on the ground wishing you're in the air than in the air wishing you're on the ground. And that is 100% the case, I feel like, in some of these recent experiences. Larry, we're on to your third chart, which is Netflix. I mean, undoubtedly the best performer out of that FANG group for most of the last 6 months here. What's the take on Netflix here?
So this is a watch list chart right now. What I always do is I always have a watch list of stronger stocks that I don't have a position in that I might consider on a pullback. So we can say that down 9% today in Netflix, it definitely falls into the pullback category. So what I'm watching here is the rising 50-day moving average, which looks like it's at about 280, if I can read that correctly. The stock is at 289. So if we take a look at the 50-day, since this recent breakout in October, it held the 50-day in November. It held it again, actually over in the middle of November. Recent bullish 50 200-day cross. So it's been the strongest of the NASDAQ, of the majors. It's not a mega cap anymore, but it's been the strongest chart of that FANG group. I have it on watch, but with today's down 9%, I'd want to see the market turn up sharply. I'd want to see the stock turn up sharply from the 50-day. So with it down 9% today, it actually moves it further down my watch list. But I'm going to watch it versus the 50-day. And if it holds at the 50-day and starts to turn up, then that uptrend is still intact.
The fact that one of the sentences you just said was Netflix isn't a mega cap anymore. Talk about 2002 and the pain we've experienced in one phrase. That was pretty well said, Larry. Thanks for that. And thanks for talking about sort of the idea of having it on a watch list and then waiting for that actionable entry point. Katie, we're to your fourth pick, which is looking at the VIXY, VIXY, which is a VIX futures ETF. What's the idea here?
Well, I can't say it's the best ETF product in terms of being tied super directly to the VIX itself, but we use the VIX itself for a gauge of market sentiment and complacency. And we do tend to see volatility as measured by the VIX spike when the market goes lower. So as a way to, in a way, sort of position for that downside, we can buy this ETF, which almost as like an inverse ETF versus the S&P 500, given the correlations there. We like this product just because it has some signs of downside exhaustion. You can see that it's a long-term downtrend, so it is a counter trend position based on this. But if you look at it as it pertains to the VIX or CBOE volatility index itself, that's actually more of a gradual uptrend channel. So that's what we're basing more of our analysis on, is the VIX itself. But we do have these signs of short-term downside exhaustion. And you can see that an oversold bounce, if you will, or a relief rally could be pretty significant just based on the distance to the moving averages.
Really good point. A great point there, Katie, about thinking about analyzing the VIX. And the question is, what instrument, what lever do you pull to actually express that conclusion? Great illustration of the VIXY as an opportunity to play a potential for higher volatility. Dave, we're to your fourth pick, which is XLE. This is a short energy idea. Talk us through the idea here.
Yeah, this one kind of pains me because I am long. I'm long NINE, which is an energy stock. But there's a saying that I came up with years ago: believe in what you see and not in what you believe. And it looks like they've rolled over in here. They took out the prior high, but unfortunately came right back in. A lot of times with a double top, they're not perfect like they show in the textbook. One high overshoots the other, and that's what we have here. And I think that gives false hope and false promise to a lot of people. And you can see that we went from the uptrend proper order to downtrend proper order fairly quickly, given the appearance of the bow tie. So a short for this would have triggered today, and a new short would be below today's low. And I don't know exactly where that is, but right below that low, right where you are there. So I think energies look like the energies are done, at least done for now. And keep in mind, what I do, as I'm slotted as a swing trader, but I'll hold positions longer term. So I go in and get a swing trade profit, take off half, and then I trail a stop higher. And occasionally, not that often, but every now and then, we'll be in a position for 2 years and sometimes even more. And people say, what's your holding period? And I say, well, hopefully 10 years or longer, but usually I'm out within sometimes a few days or a few weeks. But I will hold positions longer term. So this one looks like a bigger picture top. Again, that bigger picture technical analysis is there. Not that I'm trading off of that in and of itself, but when I see a setup within that, then I'm maybe looking to trade within that setup. So in this case, this would be a short for energies.
Very interesting. What a rotation from, clearly the leading group or leading sector in 2022, now showing signs of weakness. We've seen that for a lot of the leading stocks in there. You mentioned one that you were long, but DVN, FANG. I mean, these have been some of the better charts at times. But
what's interesting is that a lot of people get kind of hung up fighting the last war. And many years ago, my first trip over to Italy, there were a bunch of managers, and they were giving them a bunch of awards for having great performing funds. And they would all walk up and give a little speech in Italian. I had no idea what they're saying. I picked up a word every now and then. But, my thoughts were that you're not going to see these guys up here again next year. They were all running energy funds, and energy way back then, I remember diesel was like going to $5 a gallon and all. So, yeah, don't fight the last war.
There is a cyclicality to what we do, undeniably so. Larry, we're to your fourth chart, which is looking at TLT, looking at bond prices. What's the idea here?
So this is probably my favorite chart. It's one of my biggest positions, and it's going to get bigger at the close today. So there's really two things. If we just look at the chart, there was a pretty high volume flush and reversal in the beginning of November, but now we've got rising 50-day, rising 20-day moving average over the 100-day, just below the 200-day. Good relative strength. If you look down at the volume, there's been a lot of heavy upside volume coming in. And I think TLT, if I put on my fundamental hat for a second, TLT, I think it works in a variety of scenarios. Right now, even with Powell's commentary yesterday, 10-year yields are down 7 basis points today. So the stock market is buying what Powell is selling, but the bond market isn't. So 10s are down 7 basis points. 2s are only up by 2 basis points. So if they keep hiking, they're going to slow down the economy. Bonds work well in that scenario. If inflation continues to come down like it looks like it is, it just came down 60 basis points month over month. If inflation comes down, bonds should work. So really bonds work in a variety of scenarios. A lot of volume coming in just below the 200-day. It's really my top idea going into 2023.
What I love about this, Larry, you explained all the macro reasons why this should work. And what I love is the simplicity of the technical evidence, which is the chart was going down. Now the chart is going up, as you can clearly see. I love how you described why that should be the case, but the evidence sort of speaks for itself, right? Nice rotation to the upside and a great example. We're to everyone's fifth and final pick, and then we'll start sort of regrouping on what everyone said. So Katie, if you could take us through your final pick. It's actually another short idea. This is short KRE, regional banks, which have been a group that's been struggling as of late. What's the approach here?
Yeah, I mean, they've really underperformed, and just in a search for names that look a little bit different than everything else, because we do have such a highly correlated top-down oriented tape. KRE certainly fits the bill in that it has a triangle formation that's now being resolved to the downside. We've been bearish on this ETF even ahead of this breakdown, but the breakdown just exacerbates the setup in that a triangle, it kind of shows an indecisive period for the stock, or for the ETF, but they're usually resolved in the direction of the prevailing trend, which by our measures and by measures like the 200-day moving average is lower for KRE and regional banks. And when you derive some kind of price target from a triangle formation or even some kind of measured move downside target, we could be looking at additional sort of double-digit percentage declines for KRE.
It's incredible. And I love you highlighted sort of this coil pattern, the symmetrical triangle pattern resolving to the downside today. It feels like an exclamation point with the chart down, or with KRE down 4%. Again, this is a weekly chart illustrating that short-term weakness. Thanks so much, Katie, for all five of those, but particularly that last one. Dave, Warren, to your final pick, we're talking about bonds, and Larry was sort of laying out the case for the TLT. What's your approach? What do you interpret from this chart?
Well, it was going down. Now it's going up.
Done. Right?
Yeah. Yeah. It's like one thing I've been kind of noodling with lately is technical analysis apologetics, like explaining why charts and why we do what we do. And one thing that I've been kind of knocking around a little bit is performance-based metrics. And I think Katie alluded to a lot of that in what she's doing in her work, and Larry too. And so, yeah, it has been going down. You could see that it tried briefly to rally way back in August, but then it rolled back over. And you can see the moving averages also rolled over at that time too. And then in more recent times, you can see we went from red to yellow, meaning that the moving averages are kind of meandering or crossing or whatever they're doing, but they're not in downtrend order anymore or uptrend order. And then when you go green, that suggests that maybe we've turned the corner. So we have a little bit of resistance back in August to overcome, but it looks like they have the potential to at least challenge that. And then, of course, you'd use a trailing stop to possibly be on. So I would say with today's rally, we're kind of re-triggering along here. And the other thing, too, is I know Larry made some really good arguments. I'm not that smart. I'm the trend following moron, but it kind of dovetailing in what Larry said. If you look back, let's say back in the pandemic at stocks, when the pandemic was at its absolute worst and getting even more horrible, stocks began to rally. The stock market was looking past it. We're going to get through this. And I think that's what's happening with bonds. We're looking through all this mess and we're going to get through it. So we're kind of looking ahead here. So that's why I like that play for some of the similar reasons as Larry, but not quite as much macroeconomics. Maybe that those macroeconomics are going to improve, but I'm not going to confuse the issue with facts. I'm just going to look at the chart.
Yeah, and it's great. Your indicator, the bow tie, really shows this rotation from this sort of rally phase over the summer, just a clear distribution for bonds, and then look at the rotation back to the positive and the rotation at the bottom from negative to positive. It's just a really nice illustration of that that indicator, Dave. All right, Larry, we're to your fifth and final pick, which is Vale. This is a Brazilian steel company. Talk us through this one.
So this is a watch list chart right now, but it's got a couple nice characteristics on the chart. So the first thing is it just broke out of this price base. If we take a look going back to June, there was a top right about $15. We can see $15.14 in October. And then there was a very high volume move through that in the middle of November, a little bit of a back test right above that support base. And now it started to move sharply higher, rising 20-day, 50-day, 100-day. It's over the 200-day moving average right now, and it's got good relative strength. It's up today. The S&P is down almost 3%. Vale's up today. It was up yesterday. And it's got a very wide price base, good relative strength. And I think that it's set up well exactly where it is.
It's such a great, and it's so funny. I was told it's always a good time to own good charts. And this is one of those where despite if the world is melting around you, charts like this exist. If there's something to be positive about, right? There are charts like Vale that are still out there. Great illustration of sort of a classic reversal chart.
Yeah. And one thing that I like there is if it pulls back, because I always expect that everything can pull back at any time for any reason. That's just the market that we're in. But if it pulls back, the rising 50-day at $14.70 is right above where it held on that recent back test. So I think you've got two layers of support. So I'd like it here or on a pullback. Very,
very good. Larry, thanks for that. And thanks for talking through that example. Guys, this was awesome. Let me recap the picks that you shared with us, and then let's discuss some of these things as a group. We started with Katie Stockton from Fairlead Strategies, very appropriately starting with her own ETF, TACK, which was launched earlier this year, a tactical sector rotation and thematic rotation ETF. Second was gold, the GLD, which is not gold stocks, but spot gold, essentially, that you're gaining exposure to. A short idea, short semiconductors. Semiconductors obviously rallying pretty good off of the lows, but now showing some signs of weakness, and a good way to play the downside as Katie described it. We have a long VIX idea, so basically playing an increase in volatility by going long VIXY. And then back to short regional banks, KRE, which is one of the groups that's really been struggling as of late and having a pretty tough day, along with the many today. Dave Landry from DaveLandry.com shared with us 5 ideas as well. First was the 10% timing system, the TFM timing system of the S&P 500, what we would need to see to turn more positive. 2 individual names, SONX, Sonendo, and in the healthcare sector, and then a materials name, Century Aluminum, CENX. Then short energy, he reluctantly went against one of his own positions and said short energy based on that breakdown. And then long TLT, long bonds based on that rotation from bearish phase to bullish phase. Larry Tentarelli, editor of the Blue Chip Daily Trend Report, gave us 5 individual ideas as well. We have AbbVie, a biotech name in the healthcare sector, another vote for GLD, another vote for TLT. So we have a vote for gold and bonds doubled up with our contributors. We have Netflix as an idea, down pretty big today, but still on the watch list for now. And then Vale, a stock that has been bucking the trend of caution and having a nice up day on a day when most things are down. That's a steel company based in South America. Guys, this was a ton of fun, and I appreciate so much. Literally, as we're recording this here midday on Thursday, December 15th, the market's deteriorating below us as we go through it. So I appreciate you guys talking through it, and this is, I think, a very realistic discussion, right? We can't cherry pick when we record these. We have to do it real time, just like our viewers are going to be trying to do it. I'd love to just ask a couple general questions, and we'll get to some individual ideas with you guys. You know, right now we're in the seasonally strongest part of the year. November certainly was incredibly strong for risk assets. December, a little more measured, particularly this week where you're getting some choppiness to the downside. But we're setting up for January, which historically has actually been a pretty weak month. That's actually been a pretty tough month. As you are sitting where you're at now, seeing some of the short-term weakness, and you have the seasonal trends going into to January, how does that inform your ability to pick stocks now? And maybe to rephrase it, what would you be looking for from the major indexes to tell you to be more risk off in January? Katie, could we start with you? How would you sort of approach that?
Yeah, I mean, I'm definitely considering the seasonal influences, and yet the indicators also align with them. So that's the easier part of it, because I always give most respect to the indicators. They're mathematical, they're price-based, they don't lie. And then the seasonal forces are a real thing, but they're also not terribly reliable. There's definitely going to be off years for those types of phenomenon, whether it's the Santa Claus rally or something else. So we don't rely on the seasonal phenomenon, but we let them sort of inform a bias, especially if we have the indicators supporting it. And as it stands, as you probably could infer from my ideas, we do think that there's risk in January. And we actually have suggested that perhaps that with this loss of short-term momentum that's already evident now, especially today, that even though that's the issue, the fact that we have this positive seasonality through year end might prevent real meaningful downside follow through. So, and then it's kind of released to see downside follow through right at the start of the new year. So we've been looking for really a volatility event is what we're calling it, based on that VIXY position, of course. And that volatility event we think is more likely January into February as opposed to in December.
That's a great point. I always describe them, Katie, as seasonal tendencies, not seasonal absolutes, right? There are tendencies, but even the ones that are very reliable often go the other way, right? There's no guarantee. Larry, I'd love for you to weigh in if you could, because you strike me as a classic stock picker. You're always sharing ideas like Vale, right? That despite what's happening in the world today, there's a name like that looks good. How do you relate the macro, which at times has been obviously very negative, versus the micro and finding individual names? How do you relate the individual stock picking to the big picture sort of takeaways?
Well, I always want to focus on the single stock chart. So if we take a look at the AbbVie chart or the Vale chart, but with that being said, I do have a filter that involves the S&P 500. So 3,900 in the S&P is basically my line in the sand. So 4,100 overhead, we failed there 2 or 3 times recently. But below 3,900, if we close below 3,900 in the S&P, that would make me much more cautious about taking new long positions, no matter how good the chart looks, because if we get any type of a flush in the S&P, and I'm not saying that we will, but if we do, and it's weaker behind under 3,900, but if we do, it can often pull down most stocks. So if the S&P stays under 3,900, I'm going to be a lot more defensive as far as new stock positions. The 50 days at about 3,861, and 3,800 is a 50% retracement of the entire move from October. So even technically, if we had a pullback over 3,800, that would still just be a normal 50% retracement, which is a pretty standard pullback after a pretty big move. But with that being said, under 3,900, I'm going to be much more defensive. As far as single stocks in the S&P 500, gold, treasury bonds, gold miners, they're on their own charts.
Yeah, and I love that. I love that, folks. Both of you guys have mentioned focusing on the charts, and I love that. We talk so much about whether the conditions are positive or negative. The charts arguably tell you a lot of that, right? They tell you whether or not you should be in things. And Dave, it's of course a perfect segue to how I think of your approach. I won't call you a trend following moron as you do to yourself, but I think you illustrate that so beautifully, which is I buy things that are starting to go up and things that are going down. When you're looking at the S&P, thinking about the seasonality and everything, I know you showed your chart of the S&P, but as you see things pulling back today, what does that make you think going through year end into the beginning of next year?
Yeah, I kind of agree with you and Katie as far as the seasonality. It's like, yeah, there might be something there, but it could not work for a long time, 4 or 5 years, and it's still statistically viable, whatever the word they use, statistically correct. Easy for me to say. Like Larry said, I kind of agree with his numbers. We broke down out of a range around 39.50, and that's a bit of a bummer because we were in this nice little range. Now, what could happen, and this will actually test out, but I wouldn't trade it. But if you get a breakdown from a range and then it takes out the top of the range, that's actually bullish. It shakes out everybody or a lot of people, and then the market can take off. I would never buy a market on that system in and of itself, but it is something that can be useful to kind of keep in the back of your mind. I think, like Larry alluded to, it looks like we're headed down to the 50, which on my charts right now is at 38.50. Nothing magical about the 50 or any other moving average or any of the stuff that I use, but it can help to keep you on the right side of the market. So that would be of concern for me. I ignore all the seasonality or anything like that, and I just focus on price. And a famous trader called me a trend following moron. He was pretty nasty about it, and he said I would die penniless and some other nasty things. He might have even brought my mother in it, and I was very hurt at the time. But I noticed that when I fought the trends, I lost money, and when I was just a trend following moron, I tended to make money, not all the time, but over time. So I kind of grew to embrace and kind of spend that stuff in the gold, so to speak. And my clients will actually email me and say, "Fellow TFM here," when they introduce themselves. And so it's kind of a wonderful thing. It's a great enduring type of a comment. But we'll break it down today. Today's score is the major bummer. one day at a time. If we do a 180 on today's, then we're kind of back in the chop and the soup. And longer term, I still think we're trying to put in a bottom, but I certainly wouldn't try to catch the falling knife at this point. Just let it all shake out. Give it time. We're 50 something weeks into this bear market, as I described earlier or showed earlier. And maybe we're getting closer and closer to it ending, but there's no need to be a hero just yet. Honor your stops, wait for entries, and be super selective. And like I said earlier, really hard to find setups for today. I'm kind of glad what Larry said, watch lists, trends, and things. And so I'm going to keep that in mind for next show.
Yeah. There you go. Katie, you had mentioned in your comments in one of the charts about the DeMark indicators, and I know on social media earlier this week you shared, I think it was an hourly chart showing some of those exhaustion signs, sort of rallying up. And if people that aren't familiar with the DeMark indicators, kind of a classic exhaustion technique, a very, very unique set of tools, but trying to identify exhaustion. Some of the charts you shared with us are month or weekly, right? So we're looking very long-term to very short-term. How do you reconcile sort of that short-term, maybe exhaustion and now a bit of a reversal to the downside versus the long-term trends in your approach to this?
I start long-term. So I always have that monthly bar chart in mind and the monthly indicators in mind. And I would say that kind of trickles down into what I'm saying, intermediate term, short term, et cetera. When we do see these short-term signals like we had at the start of the week, we're respectful of them and we're vocal about them because we feel that even if it doesn't change necessarily any long-term bias that we have, it can help people manage risk, right? So we're going to focus across timeframes just for that reason. We're not day traders, and nor are many of our clients. But we feel that if they know that, there's heightened risk of a pullback because of a DeMark signal or something of that nature, that can add some value to their process. Maybe it means they're going to wait to add exposure to a position that they were watching, or maybe they're taking some profits in a counter trend setup, that type of thing. And those signals, when you do see them across multiple timeframes, they can be pretty powerful. So at that time, we had not just that hourly signal on the S&P futures chart on the sell side, but also a daily signal was popping up on the S&P 500 index. And that daily signal was for the first time on the sell side that we got one from that model since the December of 2021. So a year ago, essentially. And that to me was, another reason to pay attention to it and respect it. And then we always watch for confirmation. Confirmation is a big thing for us. We always look for these indicators to be confirmed by any kind of either loss or uptick in momentum, depending what kind of signal it is. And that uptick usually is just short term, but then of course can kind of enhance what we're seeing longer term.
I hope everyone listened closely to the beginning of your comments there. We talked about starting kind of macro and going micro time frame wise. I feel a lot of people get so caught up in the short term of what's happening and then try to make sense of it as opposed to starting big and going small. So I think there's a lot of wisdom in what you just said, Katie. Larry, can we pivot a little bit and talk about risk management? I did a webcast earlier this week on stops. And I had a lot of interest in that. Obviously, given the uncertainty that we're facing, given the challenges that we're facing, when I'm looking at your chart of gold or any of these other ones, you have a series of moving averages that you refer to. I would love if you could talk about with maybe any of these examples, how would you think about risk, right? So if it is a long idea and you're long, do you have a general approach to a stop or how you would manage downside risk when you're looking at one of these individual charts?
Yes. So I use volatility-based stops. So what happens in a lower volatility instrument like GLD or TLT, I'll generally run about an 8% stop, but I'll look at the chart, and if I can get underneath a moving average or underneath a key support level, I will. So if I'm in a more, in a higher volatility position, maybe something like Vale, it'll probably get a smaller position to start. I'll look at the volatility. I think it's under 3%. So that'll probably get a 12% stop. But where that rising 50-day is, I want to be sure that I get my stop underneath either a moving average or a key support level where it should be a little bit hard to find my stop. And if I can't get my stop in a good technical position, then often I'll just pass on the position because I might get stopped out just in normal volatility. But I let the volatility determine the stop, and then I look for a technical level that coincides with that.
Interesting. It's kind of a combination of a couple different approaches in there, but I like focusing on sort of the technical evidence as well. Katie, if I could go back to you, how would you generally approach a stop on some of these names? Do you have a sort of a standard approach to managing risk, or how would you think about that?
Yeah, fairly standard and fairly similar to what Larry had mentioned, although I like that kind of volatility-based approach. That's something that makes a whole lot of sense, quite frankly. We do sort of roughly like to see stop losses within the 6 to 8% range. And I like the idea of widening that out perhaps, but we almost always are looking for support. It doesn't have to be a major level, but even just a minor low to use as just a point of reference that can be static. But the biggest sort of qualifier for us is that confirmation. And by that, I mean, we want to see not just like an intraday move below a level to be stopped out, but rather 2 consecutive daily closes. So we always are looking for those 2 consecutive closes, which is incredibly frustrating at times because it's not as easy to throw in a stop loss order if that's what you're doing, because you actually have to watch it and wait for those 2 closes. But it's more often than not the right thing to do because it prevents you from getting whipped out of a position.
That's a really good point. And this just came up earlier this week. In John Murphy, in one of his books, he talks about, I think he calls it a 2-day rule, which is, making sure you have confirmation. But Tom DeMark, when I've talked to them, Larry Williams, they all have some version of that sort of validating a break. So I think that's a brilliant point there. Dave, when you're thinking about risk management, do you have a general approach, or how would you advise people just getting started to think about risk with some of these positions?
Yeah, overall, I risk 2% per trade. If you're newer to trading, 0.25% is plenty, and work up to that 2% number. Be consistent, though. Don't go 0.25%, 2%, 0.25%, 2%, or you're almost guaranteed to fail. I can almost guarantee that. I look at 2 things: setting the initial stop, and then that initial protective stop for me actually gives me my initial profit target too. So I'm looking for 1-to-1 in the first loaf, and then many to 1, hopefully, on the second one. I'm looking to hit it out of the park 400 or 500% on a trade. Now, obviously, I don't often get that. So to set the initial stop, again, 2 points, getting back to what I was starting to say, 2 things to look at. 1, where would you be wrong as a trend follower? Where would the pattern fail? And number 2, where would you need a stop to survive the short-term volatility of the market? There was a popular methodology years ago. I guess it still is. It says we should all use an 8% stop on our stocks. And that's like saying we should all wear a medium-sized shirt, something that my fat butt hasn't done since I was 5 years old. Some of the stocks that I trade, I might use a 20% stop. But if you look at the chart, it only looks like it's that far away. So you have to get outside of the normal volatility and then know where you're going to be wrong. And here's the secret sauce. The secret sauce is once you get that initial profit target, your stop is automatically brought up to break even. Now you're free rolling, okay? And you're making that transition to the longer term setup. And that's when you allow that stop to gradually loosen up over time. Never move it away from price, always move it toward price, but at a much slower rate. And that's how you adjust to the longer term trends. If you go in and try to be like the turtles did, which would fail miserably today, but they had, not to take anything away from them, but longer term trend following does have a lot of problems. And they actually discovered it halfway through, and they cut their risk by about a third or whatever it was. But if you're just longer term trend following, your accuracy is going to be abysmal and your drawdowns are going to be huge. However, that's where the real money is. So I've kind of figured out the secret sauce is to be a swing trader. And if things work, stick with them. If they don't, let yourself get stopped out.
And I love how you mentioned position sizing or bet sizing earlier. Thanks for bringing that up. Price Headley, who's an options expert, years ago, I interviewed him, and he mentioned if your position size too big, if you can't sleep at night, that means your position size just too big, and bring it down a little bit. That's great advice. Katie, just because this is our last the pitch of 2022, it's a natural time to kind of look back at the year. When you look at your experience, obviously you've had a lot of changes professionally with the new ETF and responsibilities and everything. But as you're looking back at the markets, what was your biggest lesson learned or your biggest takeaway from navigating, what has been just a frustrating, challenging year for many investors?
Well, gosh, I mean, it's respecting the indicators, and it's always the right thing to do. I think as a technical analyst, where the mistakes come in are when you let those biases get in the way. And when you, with that, of course, you're not respecting sort of the price-based action. So in October of 21, we noticed that long-term momentum gauges had started to roll. So we moved to a neutral bias and then proceeded to move to a bearish long-term bias in January. And it was really very simple. It was just based on the fact that we were seeing this deterioration, not totally unaware of the driving forces, but just letting the price action sort of guide us. So I think it's respecting the price action through these mathematically based tools and keeping the biases out of it. And, with that, you're able to manage risk. I always think that these bear market cycles draw people to technical analysis for good reason, because it shows itself as a great risk management tool. But otherwise, lessons learned, as you alluded to, just launching an ETF has been a major, major learning curve for me to climb up. But so far, so good.
And congrats again. No, I know that's you've had a lot of a learning curve, I'm sure, that will continue into the new year. But thanks for that. Larry, could you weigh in as well? When you're looking back at this challenging year for a lot of investors, what lessons learned, what main takeaways would you express here?
That's a great question. I think the biggest thing is to respect the volatility. What I'm looking forward to again is when we can just look at a chart and act on the chart and not have to worry about what the GDP number is going to be, the CPI, because there's been a lot of excellent chart setups this year that have failed just on one data point. I mean, some very clean base breakouts that started, and then a data point came out, whatever it was, and then everything reversed down. So I would say for me is to really respect the volatility. I've been holding a lot more cash this year. I've been taking smaller positions. I've been trading less, and I'm really just looking forward to, and it might be a while, but I'm looking forward to when the charts are charts and we don't have the, what's the Fed going to say or what's the CPI going to look like.
It's amazing when I think about it, Larry, how many things I've been asked to become an expert in over my over 20 some years of doing this. Geopolitical issues, the Federal Reserve, et cetera, cryptocurrencies, blockchain. It's mind-boggling what sort of things we need to have our heads around to try to navigate these things. But both of you guys, of course, focusing on the evidence is a really good lesson and a hopeful one. Dave, when you're looking back at this year, what would you say is a lessons learned or a takeaway for in your experience?
Well, I have a couple of things there. I just want to say real quick, talking to you guys reminds me, years ago, I used to host a show where people would come on panels like this. And the biggest complaint everybody had was there was not enough controversy. So I'm kind of having a love fest here. Everything I'm hearing makes so much sense today. And, not to be vain, but I think that your viewers, this is a good show. It really is. It's fantastic. I got tons of notes. So whatever, to answer your question, it's kind of like same as it ever was. It's like believe in what you see and not in what you believe. And just keep doing what you're doing. Follow the charts. The charts lead the way. I like what Larry touched upon. Pay attention to volatility. That volatility starts getting crazy. Make sure you're adjusting to that. And then again, and I actually quoted Greg too, as you said earlier, once again, not a lot of controversy today. Because that makes for a better example, being in the air, wishing you were on the ground. And I think it's been that kind of market. It's okay to sit in cash. And I know Katie has some cash or cash equivalents. It makes a lot of sense. And I'm digging that, and I think that's a secret. It's just sit and let the market come to you. Larry said a few things, and he keeps getting torpedoed by a report or something stupid or whatever. But he's chipping away at it, and he's waiting for the day when that's not going to happen, and the market's just going to behave better. So just do what you do as long as, of course, you're following the charts either up, down, or get out the way if they're going sideways.
So there's a lot of great things that we could unpack there. Unfortunately, guys, that was an hour. An hour goes by so quickly when we have three solid experts with a lot of wisdom to share. So I really appreciate each of you being part of this. Katie Stockton from Fairlead Strategies, founder of Fairlead Strategies and manager of the TACK ETF. Dave Landry from DaveLandry.com, educator and trader. Larry Tentarelli, editor of the Blue Chip Daily Trend Report. Guys, thank you all so much for joining me. Happy holidays to you all right?
Thank you.
Dave, you too.
Dave, thank you so much. Happy holidays.
Folks, that's a wrap for 2022 on The Pitch. It's been such a pleasure to bring these to you. We are excited to continue this on in the new year, and I guarantee we'll have some really good, thoughtful discussions with some great experts like we've had today. All of our previous episodes, including each of the experts' pitches and all of their great comments and wisdom, can be found at stockcharts.com/thepitch. All of our content on StockCharts TV can be found on demand at stockchartstv.com or on our mobile app as well. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well. Happy holidays. We'll see you in the new year.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.